Okay, part 5, we're going to start now. And this is chapter 7, corporate taxation, non-liquidating distributions. Okay, let's see what we've got here. A lot of this stuff we've covered. Let's see what we have covered by going through the chapter. Let's see what's new. Let's see what you need to know and what you don't need to know. There's a good deal of stuff that you're not going to need to be held responsible for because it's beyond the scope of a survey course like this. So we'll be doing some of that here too. Mainly, we're talking about property distributions to shareholders in this chapter and how they're going to be taxed. Well, they'll be taxed in one of 3 ways, basically. Either as income at a lower rate. Why a lower rate? Because it's going to be considered a dividend, but particularly, remember from tax class 1, it's going to be considered a qualifying dividend. What tax rate does that get? You know that. I think I spelled that wrong, but you get the idea. It gets that preferential capital gain rate. That is now a permanent part of the tax code. At least it's permanent until the next tax law. Otherwise, it'll be a return of capital and then perhaps a capital gain. We already know that dividends, when subject to tax, that's where that double taxation occurs. We're probably sick of hearing that. So are shareholders of corporations that are C corporations. They're also sick of hearing it, but that's the way it goes. Some payments are deductible by the corporation. Dividends are not deductible. Not deductible. That's the problem. But these payments to shareholders are salary, interest, rent are examples. And if they're deductible, the payments must be reasonable. Things that are unreasonable, the IRS could come in and say, that really wasn't a salary, that really wasn't rent to a shareholder that was renting property. It was a disguised, that's the word I used in class, disguised dividend. It's the concept of constructive dividend means the same thing. Disguised dividend is one way of describing it, and constructive dividend is another terminology, means the same thing. It's constructive dividend because the IRS came in and constructed what was a rent payment or interest payment or salary payment or something else to a shareholder as being a dividend. The IRS constructed it. They did it. They're the bad guys. Again, here's examples. How do distributions work? Well, first we're going to understand that they have to come out of earnings and profits. That's what's known as E&P. If there are earnings and profits inside the corporation, and for all intents and purposes, this is very, very, very close to retained earnings, but not GAAP. Retained earnings. These retained earnings mostly for purposes of what corporations are allowed to pay as dividends, and what makes sense from a tax standpoint to be considered a dividend. So the main thing to learn here, I think the better way to describe it is that E&P is not GAAP retained earnings. That's the lesson to be learned. So if you get a question, like a true-false question on that, you should know this much about earnings and profits. There's a lot about earnings and profits we're not going to hold you to, but this much you should definitely know. This is also what you should know, is that if there are earnings and profits, up to the extent of earnings and profits paid out as a distribution is a dividend. If there are no earnings and profits left, so this is where there is E&P, this is where there's no E&P, but a distribution is still made, it's non-dividend, and it's considered a return of capital up until it reaches the adjusted basis of the shareholder's stock. So let's do an example, because they don't give us an example here. Of course not. Why would they give us an example? Adjusted basis in the hands of the shareholder is $100. Corporation pays out $200, and they have $200 of E&P. Let's say the corporation is going to pay out a total of $600. Let's see what happens. They have E&P of $200, so the first $200 of the $600, which will leave $400. The first $200 is considered a dividend. Shareholder receives it, pays tax. Their adjusted basis is still $100. The next 400, well, the way the corporation will do it is first they'll pay out 100, leaving 300 to go before they pay that out. So we take the adjusted basis of 100, we receive 100, and now the adjusted basis is 0. This 200 here was taxed as a dividend. This 100 here is considered a return of capital. It is not taxable. It's just a return of capital. It's as if the shareholders sold their stock for $100. It's like they sold the stock for $100, in which case they had 0 gain, 0 loss. All right, so far so good. Well, they didn't sell their stock, so their basis in the stock at this point is, and I'm going to ask you to send me an email and tell me their basis in the stock at this point after receiving this $100, their adjusted basis. So you'll send me an email and tell me, and I'm not going to tell you how much their adjusted basis is, so don't pay attention to what I'm writing here. You have to figure it out for yourself. All right, the next 300 is now distributed. Their adjusted basis is 0 after receiving the return of capital. This 300 is considered as a gain, and again, I'm not telling you what kind of gain it is, so you'll email and tell me that it's a capital gain. This example is what I expect you to know, the concept of this example. Oops. All right, let's see, is that what we're holding? Yes. So a dividend for tax purposes is when you have E&P. That I want you to know. How E&P is maintained and kept, don't need to know. To know that E&P is not GAAP retained earnings, yes. How it's calculated, no. Don't need to know that. You're not going to need to know how we compute earnings and profits, but I do want you to know the theory so that it's not left as a total mystery. It starts with taxable income, but then we make adjustments. Let's see what some of those are like. Well, and when we see what some of those are like, we get the theory. That way, if you wind up getting into the C corporation practice of taxation, when you take the specialized courses that you'll have to take, the theory will help you learn it. As I said, understanding the history or the theory of the law makes it easier. So here's what happens. Taxable income, that's where we start from. But could be other income that the company received, like tax-exempt bonds, life insurance, federal tax refunds. All of this under state statute would be available to be paid out as dividends. You'd be able to use this to pay out dividends, and yet, since you didn't recognize it as part of your taxable income, it wouldn't be part of your earnings and profits or your, quote, retained earnings for tax purposes. So this gets added back as being available for paying dividends. And the same thing with the other adjustments. They're all done in order to find out exactly what you're able to pay out in terms of dividends, adjustments from other tax nuances. Some are added, some are subtracted. That's what I wanted you to know. The theory of that why earnings and profits is different than, or can be different than, GAAP retained earnings. Okay. This we're skipping. So if we're skipping that, we don't have to do this. We don't have to do that. We do need to know that distributions of non-cash property works like this. If you receive some money, that's normal what dividend is. If you receive property, the fair market value of the property is what you pick up as your dividend or your distribution. So that's the key. If the corporation is not just doing cash, but it does property, so it's cash plus property, or even if there's no cash. So let's do it that way. No cash, just property. It's considered to be given to the shareholder at its fair market value. Tax consequences when this happens to the corporation, paying non-cash property, corporation recognizes a gain, no losses, but a gain on the distribution of the non-cash property. So what it'll do is it'll figure out what's the fair market value of the property being distributed, take it off its adjusted basis, and pay tax on the gain, and that was what we called a deemed sale. Like a deemed sale, we called it in class. We discussed this. It's as if they made a sale. And the shareholder will pick up the fair market value. The shareholder will pick up the fair market value. Here's an example. Let's see what happens. The fair market value was 200. The basis was 100. So when they make the distribution, they'll pay tax on a gain as if they sold it. Shareholder, oh, get that? Shareholder. This is the okay. This is the example carried forward. Receives the fair value of 200 with the mortgage, the basis in the property. What happens? So they have a mortgage of 300. It's a fair value of 200. Sunny River Corporation reported the gain of 200 on the distribution. I'm not sure what they're saying here, but the point is that the shareholder will receive. That's a different example, actually. I see. The shareholder will receive, based on the amount of liabilities assumed. You'll figure that out when you go through it. I'm not going to spend time on it. The shareholder picks up the fair market value back here in this example. The shareholder, obviously this person here, picks up the fair market value, 200, as being the distribution to them. If it qualifies as a dividend if there's E&P, it's a dividend. They pay tax on it, and so forth and so on. According to the ordering rules, we learned all the way back here on this slide. According to this is kind of like the ordering rules. Okay. All right, moving later along. Determining the dividend. Again, this is not anything that has to do with the calculation of E&P, of whether you have E&P or what comes out of E&P is not on the list here. Stock dividend, we probably should know a little bit about that. Okay, so let's see what we need to know there. And then we'll pause. Stock dividend increases the number of shares. That's what a stock dividend does, but it just says you have more shares. If you had, stock dividend works like this. I had 100 shares. Corporation says, we're going to give you sorry, it's the number, not the amount of dollars. I had 100 shares, 100 shares. Corporation says, we're going to give you a stock dividend, and that means your dividend is another 100 shares in this example. So now I own 200 shares. Well, that's great. I like that. But I didn't pay for the extra 100 shares. It was just given to me. It can also be done as a split. Stock dividends where I had 100 shares, and it was, again, not a dollar amount. I had 100 shares, and they say that the stock split 2 for 1. So for every share I have, they reissue me shares, and now they give me 2 for 1 share. So now I have 200 shares. Same idea. Same idea. But I didn't pay for this additional 100 shares, so it just means that my basis for the new shares, now that I own 200, my basis has to be divided up over my original cost basis. So if my adjusted basis, whatever it was, is now split up or pro rata over the new shares, or assigned, let's say it that way. My adjusted basis is assigned to all the shares at that point. And I wonder if they give us an example. Of course not. All right, well, we'll probably get a couple questions on it in our test banks, and we'll go through that when the time comes. This is sort of the formula for the new stock basis. Note one thing, and this is important to know, that non-pro rata stock dividends are going to be taxable as dividends. The only time stock dividends are not going to be considered taxable to the shareholders if it's treated just like a dividend. All dividends that are dividends are distributed equally to all shareholders. If it's not equal to all shareholders, it's not pro rata, and it'll be considered as taxable. All right, let's stop here, and we'll pick up in a little bit.